Well, Q1 FY23 threw up some interesting trends in the pharmaceutical and the healthcare space. While healthcare companies such as hospitals met expectations, the India generic company's performance was weak. In fact, Jefferies in their note points out that the largest miss in Q1 FY23 from pharma companies primarily was on account of US price erosion. The pressure in the US markets combined with factors such as higher raw material prices has resulted in margins being weighed down this time round. Companies such as Lupin, Alembic and Alchem reported some of the lowest margins ever in the quarter gone by. On the other hand, hospitals within the healthcare segment met analyst expectations. Factors such as occupancies normalizing, price hikes higher, surgical and payer mix, international flights resuming, resulted in parameters such as the average revenue per occupied bed, hence margins improving for a lot of these hospital companies. In fact, hospitals on an average saw high single to double-digit sales growth and 200 to 350 basis points improvement in margins sequentially. So, is this dichotomy in the performance expected to continue? For hospitals, analysts point out the outlook is likely to remain healthy due to factors such as headroom for occupancy to rise, along with case mix and payer profiles improving further. Whilst for generic pharma companies, the recovery is expected to be only 1 to 2 quarters away. So is the preference shifting? For some, yes. Jefferies' pecking order now is hospitals, followed by contract drug manufacturing companies and finally generic companies. Similarly, a healthcare fund manager says their preference is all domestic-focused stories from hospitals and diagnostics to API companies, which could benefit from the China +1 factor. And yes, while US generic companies are likely to continue facing headwinds such as price pressure, input cost inflation to risks from US FDA inspections or even litigations, the advice from some is not to entirely avoid the play but to be selective. HSBC, for example, likes pharma companies that, according to them, are moving up the value chain and have near to medium-term drivers. They like stocks such as Cipla due to their pipeline of US launches and Sun Pharma on improving profitability in their specialty product sales. Lastly, while healthcare companies might be emerging as a preference, it is important to highlight the risks as well. Diagnostic companies, for example, which are a healthcare play, are seeing stiff competition, which is pulling down margins. An example was Fortis's margins being pulled lower due to their pathology arm in the quarter gone by. Similarly, investments in new verticals. For example, Apollo Hospitals increased their 24/7 investments, leading to an EBITDA loss in the division. A strategic investor, a scale-up of the arm, will be a key factor to watch out for going forward.
All right, take that. Thanks a lot for that. We have Sandhya Ji, who's the Group Chief Financial Officer at Narayana Health, and Prakash Agarwal, the Deputy Head Research Executive at Axis Capital, who joins in. Prakash, I want to start with you first because just from where Ekta left off, I want to take that point forward. A lot of these companies are facing margin pressures, A, because of so much competition that is coming through, and B, because of fresh investments that they're making, right? We were just speaking to the management of Kim's as well, who told us that all of these new acquisitions will result in higher costs and that will put pressure on margins. Your thoughts on how to approach this space, and what are the stocks that you still like despite the challenges?
Yeah, so as Ekta pointed out, there are clear segments which you can play with. So you have hospitals which are seeing very strong occupancy and RPOPs, which is a function of case mix, payer mix. So that is one segment which is still looking good. The second segment which we like is the domestic formulation space. Last year we saw big spike in acute heavy companies. Now we are seeing that normalization happening. So we prefer domestic companies with strong chronic portfolio, and that is our second pecking order. And thirdly, obviously the CDMO and the generics to follow. So these are the 4 key segments in that order.
Hospitals, domestic formulations, and then contract manufacturing, right?
And then the generics, yes.
And the generics last. Good to see you, Prakash. It's been a while. Thanks very much. Sandhya, good to have you with us here on the program as well. I mean, Narayana is an asset-light hospital chain. We, by the way, had the management of Kim's earlier. They made an acquisition in Maharashtra. and I put that question to them. They said, well, we like to own all our assets because, in the long run, that's better for returns on capital employed. How are things looking? I mean, how is the runway for growth looking, Sandhya, in your opinion, in the hospital space? Are things, they've been looking up for the last couple of quarters now. The big kicker, according to many, will come when, medical tourism kicks off in a big way. Could you give us some context?
Sure. Thank you for having me here. Good morning to everyone. So if you look at it, I will take first on the asset light versus asset invested model. I think I also agree that in the longer run, the return on capital is better on asset heavy or own asset model. But then we have to find the right balance because there is only finite capital available to allocate. And if there has to be a brand proliferation and we want to serve patients across, then we have to find that right balance between investment as well as asset light models. We have a mix of both. So I wouldn't say that we are predominantly asset light. A significant amount of many of our hospitals, especially in the east and south, are our own hospitals. In the newer geographies, we've gone for more asset-light models. So that's on the first part of your question. The second part is from an outlook point of view. I think there are 2-3 factors at play here. Definitely because of the ups and downs of COVID, there is a certain level of demand pent up that keeps happening, and that's why hospitals see a certain spike in certain months, and then so there is some amount of catch-up which is still there, which will result in the short term some amount of flow-through effect to the hospital sector. The second aspect is with respect to international patients. Definitely, I think there is a good. The government is also incentivizing medical tourism. At Narayana, I think in Q1 we had our highest ever international patient traffic. Having said that, at least from our point of view, I don't know whether we will hit our pre-COVID international levels because there is a lot of the medical tourism market is controlled by intermediaries who charge a certain kickbacks or who charge certain referral fees, which is against our value systems, and because that adds the cost to the patient. So some of those arrangements we don't work with. So therefore, I do not know if as Narayana we will hit our pre-COVID highs in terms of medical tourism or international patients, but that's another area where growth will come from. And I think really one important aspect is that India as a country is very, very underserved in terms of healthcare. And now with a lot of focus coming on healthcare and
Sandhya,
getting treated, becoming more and more. Yeah.
Got it. I wanted to take that point forward because what we're also noticing is while healthcare is picking up in a big way, some of these smaller companies are finding it very hard to sustain, right? You look at it in any segment, whether it's in pathology, diagnostics, etc. There's so much consolidation happening. And as Prashant was also saying, we spoke to the management of KIMS a while back. They're looking at acquisitions as well. Is Narayana Health also looking at inorganic acquisitions? Anything on the cards in this calendar year?
So we definitely have a stated intent that we will be doing some inorganic play, especially in our Bangalore and Calcutta markets. It can be either brownfield or we could do a greenfield option as well, buy land and build. We do want to expand in Bangalore and Calcutta and in some of our, and where our return on capital is higher in terms of other markets, we will make strategic investments. So that is on the cards, but I don't think I'm in a position to share any of the work that is currently happening for obvious reasons. But definitely we have a stated intent that we will expand because we are almost nearing capacity in some of our flagship hospitals. We need more capacity, so we will build as well as we will, look at some inorganic play.
Absolutely. Prakash, since you said hospitals is right up there in terms of the different segments that you cover and what you like the most, which over not a 1 year price target kind of thing, these management teams, the underlying value systems, and it's a sector where that also matters, right? the culture. Where will investors make the most money? Which hospital stocks you think are best suited from a 3-5 year perspective?
So we have coverage on 3 hospital names. We can talk about that. So one is Apollo Hospitals, second one is Max Healthcare, and third is Aster DM. So all the 3 hospitals we have a buy rating, and all 3 have different plays. So if you look at Max, it is clearly a play on expansion within their existing hospitals. So their ramp up is going to be really fast in terms of both occupancy and RPOPs. So that is one of our top picks. Whereas if you see Apollo Hospital, their new hospitals are doing extremely well. The catch-up has been very fast, and their matured hospitals are also doing very well. Where the drag is actually the 24/7, where the management has a view that going forward there is a big expansion, omni-channel presence that will happen online and offline of pharmacy. Not only pharmacy, but having diagnostic, doctor consults, etc. So it's a little longish plan, 3-5 year plan, but that is going to play out soon. And the third is Aster DM, where valuations are always on the lower side, given it has international business in the GCC area, and growth challenges are there. But then again, it is a value play in terms of the India hospital also doing pretty well. So that's why all the 3 are buy ideas, but all the 3 have different plays in that sector.
Okay. Sandhya, I wanted your thoughts on the growth that you expect going forward, because in Q1 you saw very good numbers, especially for the India operations, your highest ever margins for the India business at 16%. What kind of growth are you expecting to see for the rest of the year?
Sure. So without making any forward-looking statement, I do want to call out that we are having definitely a headspace in occupancy in some of our hospitals, and especially our new hospitals, and those are starting to build up. And so therefore, I do believe that we will be able to see some good momentum there. Secondly, in Q1, it was our Cayman operations was a bit muted, given that Cayman was going through a second wave of COVID and there were severe lockdowns. So both from a patient traffic point of view, as well as from a doctors getting quarantined, our clinical staff getting quarantined point of view, we had a muted Q1. So we will surely see recovery on that in Q2 and beyond. So that would also bring through some amount of growth for us. And like I earlier mentioned, we are looking at inorganic, organic play, and that will also give us some tailwind. So without giving an indication, at least we see the momentum to be positive.
Prakash, the other development in the space has been the Piramal demerger, right? You have some thoughts on what the pharma business should be valued at. Do you want to tell us?
Yeah, so we had a note out today itself on the Piramal demerger. So it's getting a record date, and demerge date is the 1st of September, expected to be listed by Q3, which is before December. 3 businesses, CDMO, second is the critical care business and the OTC. So all the 3 businesses have long runway of growth. We expect them to recover from their current, currently they are facing some execution challenges given the COVID, and the business is spread out across global. So we expect that recovery should happen from second half of this financial year, and going forward, there are a lot of initiatives the management has taken in terms of senior hires, in terms of capex plans that they're adding. So I think it should do well over a period of 1 to 2 years.
Okay, well,
Prakash, from a valuation perspective,
sure,
if I may just add.
Go ahead.
So our price is around 190 rupees per share of the demerged Piramal Pharma Limited. So which is, current PEL is giving 4 shares to the existing shareholders, plus there's a 20% equity that will be added for Carlyle. So the value comes about $190 per share.